We'll continue with this item 6, selected financial data in the 10K report for Berkshire Hathaway. And this is an overview that is required to be in the report. And it's an interesting overview, but there's limited amount of analytical value here. So there's select financial data for the last 5 years. We can see the lumpiness in the insurance premiums earned, the growth in the sales and service, the leasing revenue, which have increased significantly over the past 5 years, the railroad and utilities, the interest and so forth. And we get down to, it's good that they isolate these investment and derivatives gains here. So the earnings attributable to Berkshire Hathaway. So again, the footnote that it includes the investment and derivatives gains and losses. So there's really not much value there. And then the earnings per share, which again are reflective of that figure. So don't add too much value. We get a glimpse of what the balance sheet looks like. Total assets of over $800 billion. And then we also have a glimpse into what the liability side of the balance sheet looks like for Berkshire's companies, the insurance and other. So basically the manufacturers, because the insurance companies don't borrow too much themselves. And then the railroad and energy business. So Berkshire had year-end shareholders' equity of almost $425 billion, which I believe is the highest level of shareholders' equity, at least in the United States, if not pretty close to it. Worldwide, there may be one or two, maybe in China, that have a larger shareholders' equity. But because Berkshire has retained its earnings, that last dividend that it paid in 1967, all those earnings, basically, with the exception of some share repurchases, have been retained, which is why it's grown to that degree. We can see the trend in shares outstanding, as well as the book value per share. So even though that data was not reported on the front page of the report, we could still make our own calculations here. And again, the Class B are 1/1500th of the A. So here we start to get a nice glimpse into what we're going to see as we analyze the Berkshire Hathaway financial statement and its results for 2019. And while some of this might seem pretty daunting, it's important to remember analysis is just the breaking down of anything, really, but in the context of financial statements, it's just going deeper and deeper at various levels, and then pulling back to certain levels, seeing the impact on the overall, and then connecting some of the dots between each segment that you're looking at. So it's sort of a process of going up and down various levels. So we start here with Berkshire's earnings, and importantly, these are after tax and after any non-controlling interests, such as the fraction of Berkshire Hathaway Energy that's not owned by Berkshire. So, we can see insurance underwriting, which is distinct from the investment income, how that has fared over the last 3 years. So we can see this $325 million of underwriting income, which means that the cost of float was negative, which is a good thing. This investment income, which is directly related to the investment portfolio, how much in dividends and interest Berkshire earned. Net earnings from the railroad, utilities business. So this is really just Berkshire Hathaway Energy. The many MSR, manufacturing, service, and retailing businesses. So those 5 categories plus this 6th one here of other, you add those up, those are the operating earnings after tax that Buffett really focuses on. And well, and he says that the investment gains are important over time. They really do introduce quite a bit of noise into the financial statements. So they are detailed separately here in this line. And then, of course, we still have, because this is a 3-year look back, the $29 billion gain that was reflected in earnings from the 2017 tax law change. So this next section here breaks down some of what's in this table here. So a key piece is this the 2017 tax change from 35% to 21%, which affected the business's earnings after tax. So I won't go through these sections, but essentially what it's doing is providing a very high level overview of the insurance businesses, the railroad, the energy and utilities business. You can read through this, and it gives you just sort of an essence of what happened in each category. But we're going to get into some of the more specific details and the hows and the whys, and really get a sense for how each of these segments did and what were the components of each of them. And again, using that analysis, which is just digging deeper at each level. So here we really get into the insurance underwriting and some key pieces of information here. When Berkshire talks about catastrophe losses, its insurance of, say, hurricanes or earthquakes, the two big ones that come to mind, losses that exceed 100 million are considered a catastrophe loss. So there may be others that don't meet that threshold, but generally loss of 100 million is considered a catastrophe event. So there were a few events that affected all of Berkshire in 2019. And so pre-tax, these were 1 billion in 2019. We can see, 1.6 in 2018, and then this 3 billion from, I think there was 6 of them in 2017. It's important to note a key source of value at Berkshire Hathaway is its float. But it's the float. What comprises the float are these unpaid losses, and these losses they're based on facts, but there's a significant amount of estimation that goes into these, especially when they get into the longer tail events and coverages that might stretch 20 years or more. So these totaled $115 billion. So any change in the estimation of those ultimate liabilities is recorded in the year in which those changes are made. So there's an up and down effect from changes in assumptions, and those are called loss development. So favorable loss development means those losses will be, Berkshire thinks the losses will be less over time, so they've marked them down. And unfavorable development means just the opposite, that they've increased the ultimate liabilities. And even though they might not be paid out in the year in which those adjustments are made, they are recorded in the year that they're made. And they can change from year to year. So you could take the same loss event, whatever that might be. One year they think it's going to ultimately cost them more. Even take, for an example, September 11th, when that first happened, there was an initial estimate of liability, and so if their ultimate losses in 2002, let's just say, increased, they thought the losses were going to be worse, they would record a loss and flow that through the underwriting line. And then what ultimately happened was their reserves were conservative. So as time went on after the event, as facts came to light and things became clearer, they marked those down and recorded a gain in income. But generally speaking, Berkshire is pretty conservative when it comes to its underwriting. And we'll have, there'll be a table later on that will show us the loss development over time. And it's a pretty interesting and important table to understand. So we'll jump into the specifics of some of the businesses here under the insurance umbrella. And the first one, the biggest, the biggest standalone is GEICO, but it's broken down into these three main categories. GEICO, which is a primary insurer, but because it's so big, it's broken out separately. The Berkshire Hathaway primary group, and then the reinsurance group. So there's pre-tax gains and losses here, income taxes and non-controlling interests, as well as the net gain. So that $325 million that you see here is the same number that we saw right here. So really, if you can picture it as we're taking a look at this line right now. We're kind of zooming in, and then we're going to zoom out, look at the investment income, zoom in, look at the railroad, zoom back out. And so that process continues as we go down the line. And even within that 325, we're going to zoom in deeper. And that's all analysis is just digging deeper. And so, of course, that tax rate that declined from 2017 to 18 provided a boost, all things being equal, to Berkshire. So we start with GEICO. GEICO writes coverage in 50 states, so it's a big insurer. We saw it had almost 14% of the market in the United States for passenger auto, at least. And we can see the premiums written and premiums earned. The difference between written and earned are simply that until you have driven your vehicle, until that coverage has been provided to you, that premium is not earned. And the unearned premium, the money that essentially sits with GEICO until it's either paid out as a loss or is recorded as income, it actually is a component of float, unearned premiums. So these can diverge quite significantly over time, but with slower, fairly slow growth, fairly steady growth, they tend to track each other over time. And the combined ratio, so the two main components of expenses for any insurer are its losses and then the underwriting expenses. So the losses are, covered losses, the insured, the money that's paid out. And then the underwriting expenses are the amounts, for staff, the buildings, everything else that is required to run the business. And GEICO has an advantage over, its main competitor, I guess, is, Progressive. But the big one that they're both gunning for is State Farm. But GEICO can offer a low premium and still do well for itself because these losses are so modest compared to its overall expense ratio because it goes direct. So when we talk about a combined ratio, this 95.8, that's comprised of the loss ratio plus the underwriting expenses, and that's all of percentage of the premiums earned. So anything if it's below 100, if they paid out below 100% of their premiums earned, GEICO records a profit. So if we were to take this, I guess 4.2% profit margin, basically, that's what this 1506 divided by the 36 or 35.6 billion here represents. So GEICO made a profit. So we can see that there. So now we want to dig deeper, and we're going to say why. So starting at the top line here, premiums earned and written, they increased, 5.5 to 6.5%. Why did that happen? So they had more policies in force, pretty good growth, 6.4%. But then, so that they had more policies outstanding, but the average premium declined. So they're adjusting their premium. GEICO wants to make money, but they don't want to make too much money. The purpose is to make a profit, but GEICO has had significant growth because it passes along savings to customers. And the way it does that is by, I don't know if they've said this recently, but they pretty much target a 4% profit margin. So they will adjust premium pricing over time to bring the combined ratio effectively to that 96% range. So we're told that they did over a little more than 1 million new premiums in 2019. So we get into the losses and loss adjustment expenses. So this 81.3% loss ratio, we can see it's up from 2017 by 2.5 percentage points. So the two major components of losses are frequency and severity. So basically, in plain terms, how many accidents and how bad are they? So in 2019, there were higher severities. So the accidents were worse in terms of the cost that GEICO had to pay out. And there was lower storm-related losses. In 2018, there were some catastrophe losses that GEICO had. Frequencies for property damage and collision declined 2 to 4%. Personal injury protection, 1 to 2%. And bodily injury was relatively unchanged. So personal injury is yourself, if you're the claimant, and bodily injury is an injury to someone else. Average claim severity were higher in the 4 to 6% range. So people were getting in fewer accidents, but they were costing GEICO more. And you can see, bodily injury coverage 7 to 9%. That's a pretty steep increase in cost. And we don't know exactly what went into that, but a lot of times it's this social and judicial inflation where you get into an accident and a jury awards. The bias is to award a lot more. So we don't know why that happened, but that's a pretty high increase in bodily injury severity. So then this is when we get into the loss adjustment expenses. So GEICO increased claim loss liabilities by $42 million. So all of the prior losses that GEICO incurred prior to 2019, when they looked at those, they determined that the ultimate payouts would be $42 million more in the future. So that $42 million is reflected in here, and that's a pretty small amount of this number, but it can be pretty big. And so that was an increase, and there was actually a decrease in 2018. So these numbers go up and down, and the biggest thing is just making sure it's not huge, and it wouldn't be huge in GEICO's case, but it's not huge in terms of a percentage of the losses or its reserves. So the underwriting expenses, those are the overhead costs basically, more advertising, and essentially more employee costs, raises, as well as probably increases to staffing to handle those additional million policies. I'm not going to go through 2018 for any of these analysis unless there's something big, but you should go through and read. If you're not familiar with 2018's results, you take the same approach and just learn what happened. But I just pulled this one out here, that the losses from catastrophe events were $105 million in 2018, and they named these two hurricanes as well as a wildfire. And then 2017, GEICO had $450 million of catastrophes. So they break these out so you can have an understanding of, kind of what's the one-time events, what were those big things that happened to cause the results to vary. So now we move into the Berkshire Hathaway primary group. So this is a host of different primary insurers, and they do all kinds of different types of business all over the country, and in some cases in different parts of the world. one thing to point out here is, we just came and we just looked at the GEICO, and we saw underwriting expenses right around 14 to 15% of premiums, and we come down and we look at the other primary group, and they tend to run mid 20% range. It's not good or bad. They are a different type of business. An auto policy is essentially a data-driven type of insurance where you can have a computer look at credit scores and a whole host of other things, and give you a premium, and they can keep costs down in that way. But some of these other insurers under the primary group, they run very good businesses as judged by these combined ratios here, sometimes under 90%, but their expenses are higher. They write lower volumes of business. It's more specialized. Sometimes they have to, it's more labor intensive. And so that's reflected there. And it's neither a plus or a minus. It just is. And, I guess the key is how are they trending over time? So their expenses, they're pretty much flat. But what really changes is the loss ratio. And that's that's what's highlighted here. But they do pull out, in terms of premiums written, increased 15% over 2018. You had this huge increase from the Berkshire Hathaway Specialty Group, which is actually a relatively new unit, Guard, MedPro, and then it also benefited from this medical liability mutual acquisition, and they divested applied underwriters for basically competitive antitrust reasons, I guess, but they didn't want to get rid of it, but they did. They sold it back to the founders. So they've primarily focused on the loss ratios, and we can see that the loss ratios increased about 4 points, a little over 4 points here in 2019. And so part of it was a reduction in prior year loss events of 500 million compared to 715 million in 2000. So we can see the reasons why those adjustments were made, and there were no losses from catastrophe events in 2019. So it doesn't. It sort of leaves out in some ways why the loss ratio went up by that 4 points, other than a reduction in the favorable loss reserving. So that favorable loss reserving went down, which increases the loss ratio, all things being considered. So it's a good thing that they're having that favorable loss development. Now, the real bread and, well, the real big gains in float come from Berkshire Hathaway Reinsurance Group. And it's important to note that time value of money concepts are essentially the key driver in reinsurance in general, but specifically the retroactive and periodic payment annuity business. They know that there will be losses, but there are the duration of the float is such that Berkshire can make more money investing the float, which offsets the loss. It's reported that because they break the underwriting off separately from the investment income, you see losses generally in the retroactive and periodic payment business. But we know that they provide that float, which is very important. And there's some accounting that's important to understand with the retroactive business specifically, which is when those contracts hit the books, a retroactive contract does not cause an underwriting loss day one. So that large retroactive policy that they did with AIG, round numbers, basically, they received a premium of $10 billion. They thought that they were going to lose $16 billion, but that net of, say, $6 billion loss was not charged to underwriting that year. They actually book an asset called a deferred charge asset, and then that asset is amortized down into underwriting income over time, which in theory offsets what they should earn in investments. But we can see again, when we zoomed out, we saw the insurance underwriting as a whole, and then we saw the Berkshire Hathaway Reinsurance Group, that's this 1472, and then we can further break it down into these lines. So there's really, it's really, sometimes it's complex, but it's really not too complicated. It's just a matter of going deeper and deeper at each turn. And so the report will walk us through each of these lines, but we can see each major line under the reinsurance right here summarized for us. So property casualty, $10 billion in premiums written, a little bit less than that in premiums earned. That's a good bulk of the business, and those are those contracts like the catastrophe coverages and so forth. So here we can see premiums increased almost 11%. There was growth in the U.S. and international markets, new business. Because some of the business is written overseas, in the London market, and actually, all over the world for that matter, both the liabilities as well as the premiums are affected by the value of the U.S. dollar against these other currencies. So that can play a part in the results, and it's important to note, and they do break that out in this report. So we can see there was a 1.7 billion of the premiums in 2019 came from this quota share arrangement with Insurance Australia Group. So this was a treaty type arrangement where Berkshire said, we will take 20% of all of your premiums for 10 years. So that runs through 2025. And Berkshire has given us the information that 1.7 billion came from that. So we're moving into the losses and loss adjustment expenses. These do fluctuate quite widely depending on the level of catastrophes. And we can see 2017 with those big catastrophe losses, 95%, which caused a pretty significant loss for Berkshire net under the Berkshire Hathaway Reinsurance Group. But it's come down in 2019. But given the volume of business that Berkshire does, there's almost always some sort of catastrophe loss. It's just the magnitude of that loss. So in 2019, there was 1 billion of losses from catastrophes, which again are any single event of over 100 million of loss. And usually Berkshire reports on a calendar basis, and most storms occur in the fourth quarter. So they've broken out that 700 million came in the fourth quarter. We can see what happened in 2018 and then 2.4 billion in 2017. So they break it out and they say these two typhoons, wildfires are what caused those catastrophe losses. We can see what happened in prior years as well. We also see these types, the reinsurance lines tend to have the highest dollar amount of loss adjustment. So we can see in 2019, they decreased. So there was favorable loss adjustment in 2019 to the tune of 295 million. Now, because Um, so one of the things to be aware of, these loss adjustments seem big, and they are a lot of dollars, but the most important thing is the change in relation to the net unpaid claim liabilities. So a 1% change, which was the actual in 2019, is a pretty modest change. And I believe Berkshire, they've said in the past, decades ago at least, that a 5% change, favorable adjustment plus or minus, is kind of the not target range, but anything outside of that means you haven't been reserving appropriately. So, um, anything can change, especially with these long tail liabilities. But a 1% change is fairly modest. The life health business is a pretty straightforward business. They do fluctuate from time to time, depending on the assumptions that go into it and some of the changes in the assumptions. But it's a fairly stable business. Um, here's an interesting tidbit. So every now and then, Berkshire will amend contracts, or there will be something that happens that they point out. And in 2019, they had a contract with a reinsurer that was renewable yearly, but they terminated the contract. It was a mutually agreed termination that, so Berkshire was no longer on the hook for these liabilities that it had insured, but there were uh, reduced premiums by 49 million in 2019, where in 2018 they earned almost $1 billion from that contract. So they point that out to tell us what happened. Growth in international markets. When you get into the results of the earnings for the life health, a lot of it is based on. So there was 163 million attributable to a reinsurance amendment, but most of the action comes from assumptions and the sort of actual trends of claims. Are people dying faster, living longer? Interest rates have an effect on this business because of the discount rate that's included. And then there's also this periodic amortization of expected profit margins. So Berkshire, in most cases, receives the premium up front, and kind of like the retroactive business, books this asset that is amortized over time. And so that hits the results. So we'll get into the retroactive reinsurance segment, and this provides a big chunk of Berkshire's float. These contracts tend to be very small in number, even irrespective of the dollar amounts. They don't. I don't know if they say it here, but this 517 million in 2018 was essentially one contract. So I wouldn't be surprised if that was the case in 2019. They do say it was a limited number of contracts in each year. But the big one was 2017, that $10.2 billion premium from AIG. And this business is so volatile and lumpy in terms of premiums that come in, that you really should not look from year to year trends in the premiums. It really just depends on the appetite of the market and other insurance executives as to what types of contracts get done every year. But the big one was 2017. And we can see that there was this foreign currency adjustment of 76 million, loss of 76 million in 2019, $169 million gain in 18, and losses of 264 million in 2017. So that fluctuates a lot, and it's really not an indication of the underwriting abilities of the management team. It's just sort of what happens. So the losses from this segment typically come from this deferred charge amortization from that asset that's set up. And again, it's important to note that the Berkshire has received, I'll just use the AIG contract as an example. That $10.2 billion was received. It's in the bank, so to speak. No one can take it away from Berkshire. So that's in the bank, earning either interest or dividends. Wherever it was invested, it's earning to Berkshire's benefit. But none of that shows up in underwriting. Only the losses from the contract. So a big chunk in AIG alone contributed $646 million of deferred charge amortization in 2019, and we can see that $42 billion of unpaid claims are outstanding. So these are huge dollar amounts. They tend to go over decades, and there are changes from time to time, just like any other insurance contract. There are favorable and unfavorable development, but because of this deferred charge asset that's set up, it is slightly complex. And if you do have a question, I'd be happy to make a segment going into this in more detail. But essentially, there was a loss of $378 million, unfavorable loss, but because of this deferred charge asset, it ultimately net cost underwriting $125 million. So that unamortized deferred charge asset was $13.7 billion, and the actual unpaid losses were about $42 billion. Periodic payment annuity, another business like the retroactive, where it's almost expected to produce underwriting losses over time. And these premiums, again, a 25% decrease. It's really not too much to read into that. It just kind of is. They come in chunks, and they even say here, volume can be changed rapidly due to changes in pricing. So basically, Berkshire sits around, they search for these deals, but most of what goes across their desk gets rejected. But they will wait until pricing in the market becomes such that they can jump on these, and they will write huge volumes when the pricing is right. So this recurring discount accretion of annuity liabilities, that's no different than that deferred charge amortization from retroactive. It's just called something different under periodic payment annuity. And again, these are contracts that Berkshire receives the cash up front. And, it's really just how well do they do pricing these. There's foreign currency effects here, and we can see that they're discounted. There is that certain contracts are discounted because of these time value of money effects. Some aren't. But in this case, the weighted average discount rate was 4.1%, which is quite higher than the prevailing interest rates. So that that is a key assumption that goes into this, because the higher the discount rate, the lower the future liability. And Berkshire is generally conservative in what it does. So another insurer, if it wanted to decrease its liabilities, might increase that discount rate. So it really comes down to an insurer's track record and how well they have done over time, which gives you an indication as to how honest they're being with the numbers, because these numbers really, when you get into numbers this big in the tens of billions, are really can be swayed quite a bit by management's assumptions. Next, we'll move into the insurance investment income. So most of Berkshire's investments are held under the insurance companies to bolster their strength. One to give them the flexibility to underwrite more business, but also that the float is generated in the insurance business, and the investments generally stay under the insurance heading. So we can see how much Berkshire has earned in interest and dividend income. And of course, the change in the tax rate affected Berkshire from 2017 to 18 going forward. But because dividends are taxed differently, there's a lower tax rate because the companies that the companies have paid income tax on their earnings, and then they pay them out as dividends. So to avoid the double taxation, the full double taxation, there is a lower effective income tax rate for dividends received. So they go through here and talk about how interest rates were higher in short-term investments, which increased interest income, as well as they had a loan to Seritage Growth Properties. Dividend income can also be affected by the amount of investments. So if Berkshire, if it underwrites a big policy like in 2017 and receives a big chunk of money, that money will begin to earn interest and dividends maybe, and that contributes to the growth. So you have this compound effect from increasing the amounts essentially in that account, as well as in this case, dividends had increased year over year. This is to give you an understanding of what goes into float. These are the specific balance sheet categories that comprise float. If you go to do this from the balance sheet, you'll come out to a figure that's slightly different than what Berkshire provides, which is 129 billion. There are certain other minor categories that don't show up, but these are the major ones here. So unpaid losses, if they owe money but haven't paid them out, that's float. It's a liability, but they can use the money in the interim. So all of that, the unearned premiums, if you've paid for your home insurance or car insurance for a year or 6 months and haven't used it, essentially, that's money that Berkshire's holding. As well as, if they're waiting for receivables on from certain things, reinsurance receivables, or even receivable from their customer, that's a negative. And these deferred charges are also a negative because they're monies that have not been received, rather. So it's an asset that's set up that essentially doesn't represent cash. So that's a negative. But add all those things up, and you come to float of 129 billion as of year end, which is up 6 billion from the prior year, which is quite an astounding result for an insurance business this large. When pre-tax underwriting income net, when that happens, it's called a negative cost of float, which is actually a good thing. That means Berkshire was paid to hold the money that it was given. When it has an underwriting loss, the cost of float is the underwriting loss divided by the average float. So in 2017, which was the only year in the 3 years that they had that loss, the cost of float was 3%. So you can think of it as a borrowing. So in 2017, average float was something less than 114 billion, but I think it was around 100 because of the large AIG contract in 17. But it was essentially as if Berkshire borrowed all of that money and it cost it 3%. So even when Berkshire has an underwriting loss, the important thing is not the dollar figure, but the rate as a percentage of average float. And in many times, essentially, when Berkshire generates a profit, it is borrowing at a negative interest rate, and when it's has an underwriting loss, it has a positive interest rate. And in most of the years in which Berkshire has operated, even the years which it has a cost of float or a negative underwriting, an underwriting loss, it has borrowed essentially at lower than the cost of the U.S. government, which is quite an astounding feature of Berkshire, that it funds a significant part of its assets with very low to no cost liabilities. So if you add up all of the cash and investments in the insurance business, you come out to $326 billion, which is just a huge amount of resources available to protect claimants. And most insurance businesses, this is flipped. So Berkshire has just $18 billion in bonds and $326 billion in cash and equities. Equities 240 compared to say the 18 and a half in bonds. Berkshire, because it writes so little in premium volume compared to its net worth, that affords it an advantage to invest in what over time will be higher yielding securities. So Berkshire knows that businesses will do well over time, and in effect, its conservatism allows it to be better over time because it doesn't write as much business as it could. And other insurers that do that must, by nature, invest more in bonds. And the low interest rate environment that prevails are really hurting those insurers. So that's the end of the insurance segment. And we'll move into Burlington Northern Santa Fe. We'll take a look at Berkshire's railroad, Burlington Northern Santa Fe. And as we saw in the other section, it's a huge West Coast, primarily Western United States-based railroad, competes with the Union Pacific. And some things to note here when you're looking at this. BNSF passes through fuel costs, most of its fuel costs, to its customers. So that the top line is not always as relevant as it may seem. And it is regulated. The railroad can only earn so much on equity. So a lot of this is passed through. And what really counts is volume through the railroad. And because of the tax rate change in 2017, you can see down here, the effective tax rate went down from 37% to 24%. That has an effect on the net income. But when you look at the economic performance of the railroad, you really want to look at the pre-tax earnings. And we can see over the last 3 years that has increased quite nicely. So we can see that the revenues were down 1.4% in 2018. And you break that down between pricing and volume. So there was an increase in pricing by almost 4%, but a 4.5% decrease in volume. So they moved less stuff. So that 10.2 million cars or units. There was a favorable arbitration hearing. They talk about the weather and flooding that negatively affected their ability to move freight, and as well as cost them money. So we move into some of the detail here. Again, BNSF breaks its business into four main categories, one of which is consumer products. And again, focusing on volume here, volume decreased 4.6% because of lower demand, truck capacity, competing forms of transportation affect how much business BNSF does, and then lower imports from the West Coast ports also affect it because that demand is not there to the degree that it was. The next category is industrial products. That decreased 3%. So softness in the industrial sector, lower volumes, weather conditions played a factor. But they do talk about some of the strength in the energy sector petroleum products, LPG, and so forth. Agricultural products volume decreased 5%. So because of macroeconomic trends, export competition from non-U.S. sources, trade policies affect the railroad, as well as that weather again there. Coal is the last of the four categories, 5.3% lower volume. And when you look at this over time, coal volumes are on a permanent downward trend because of phase outs in the utility companies that are using coal. So that affects the railroad. And of course, they point to the weather here again. And because coal competes with other forms of energy, lower natural gas prices hurt coal demand. Operating expenses, those are the things that the railroad can control if it can. Lower volume, of course, creates lower costs, lower fuel prices. They have cost control initiatives, retirement plan, curtailment gain. A lot of these are kind of, they tell what happened, but there's not a huge amount of detail. But you can, BNSF specifically, you can look up its 10K. It does file its own 10K with the SEC. So we can get a deeper look into what happened with the railroad, but this pretty much tells the story. And the biggest thing over time is how much it does in volume. And it has an advantage in being on the West Coast, which has structurally, it should grow faster than the East Coast due to population increases. So they had 120 million curtailment gain from a defined benefit plan. Just again, interesting to note. And this whole paragraph here, I mean, it's they go through some of the different causes of the decrease in operating expenses. We won't touch on 2018 compared to 17. You go through the same type of analysis. The Berkshire Hathaway Energy. So Berkshire owns 91% of Berkshire Energy. And like the railroad, really, ultimately, there's a lot that happens within this business. But ultimately, it's a regulated business for the most part that is allowed a return on capital. And its pricing is reflective of that return on capital. So this is a business that was on the surface benefited from the tax reduction in 2017, but because it's regulated, it does not receive the benefit of that tax decrease. It must pass along that benefit to its customers. And so there's various ways that Berkshire Hathaway Energy does that, and those are listed here. So it's a big business, $20 billion of revenues in 2019. As we noted before, the Berkshire Hathaway Home Services is within the energy business, and so that's maybe a quarter of the total revenues. This is kind of interesting. The overall summary income statement for Berkshire Hathaway Energy. So again, if you focus on pre-tax earnings, which really tells you what's happening with the economics of the business, and as we would expect, the business is stable. So over the last 3 years, it's gone from $2.5 billion to $2.6 billion, pretty stable, which again we would expect. But what's really interesting here is the income taxes. So there are brackets here, and in both 2018 and 19, Berkshire Hathaway Energy had higher after-tax income than pre-tax income. And the reason for that is because of its significant investments in renewable energy, specifically wind as well as solar, they get these income tax credits, and those are reflected in, it actually says it right down here, wind power generation. So those are reflected in income tax, and that causes net after-tax earnings to actually be higher. And Berkshire Hathaway Energy, if it was a standalone utility that operated like most utilities and paid out most of its earnings and dividends, it probably would not, well, even if it didn't, it would not have a significant taxable income to take advantage of all of those tax credits. So because it is under the corporate umbrella of Berkshire Hathaway Energy gains a benefit to use all of these tax credits. So, of course, the tax rate was negative. These are the major components of Berkshire Hathaway Energy, and these businesses are all large in themselves. So together, Berkshire Hathaway Energy is truly huge. So I've just gone through this table here, and we can see, you kind of want to find out, all right, what happened in some of these. Most of them are flat, and these are the after-tax earnings. But to see what happened here, it's kind of just you tend to look for that flat earnings trend, and to see these jumps, you kind of wonder what happened. So I've just highlighted some of these here, and we do have the detail within here. PacifiCorp, that one was fairly flat. MidAmerican Energy, this segment operates in Iowa and Illinois, which has most of the wind generating capacity. So those are where those tax credits came in. So we can see why, and again, it's mostly due to those wind credits. NV Energy, here we can see after-tax earnings went up by 15%, lower operating expenses, lower margin. Talks about volumes, rate reductions attributable to the tax law change. Northern Powergrid, this is based in the UK, and here often there will be the foreign currency effects will affect this business. The natural gas pipelines, again, fairly boring regulated business, but they do increase, they do provide quite a bit of income to Berkshire and Berkshire Hathaway Energy, increased 9% over 18, and volumes, rates play a part, as well as temperature. That's not mentioned in 2019, but colder it is, the more natural gas people use, and that will affect its business over time, up and down. Other energy businesses, there's a host of different renewable projects in here. There's a Philippines-based utility project. AltaLink is the Canada-based transmission asset that they have, and then the real estate brokerage is also listed here. And we can get a glimpse of what happened in that market in terms of increased refinance activity. So they have a mortgage business, acquired some different units, and there was also lower volume and lower margins on from Berkshire Hathaway Home Services. And we move into the manufacturing, service, and retailing businesses. So the manufacturing, service, and retailing businesses, it starts by breaking them out by the manufacturing and then the service and retailing. So we can see the high-level overview here. And because of this tax rate reduction in 2018, beginning in 2018, we want to focus on pre-tax earnings. It's the best way to analyze the businesses because that really gets closer to the economic results of the business. So 2017 to 18, there was this pretty large jump in earnings. So we know pre-tax that was organic. That was some real change. And a lot of it, really big jump was after-tax income, but a big part of that was because of the tax rate. But we can see in 2019, these earnings overall were flat, essentially, at about 12.3 or 4 billion. And but of course, there's a lot more that's happening under the surface, and that's what analysis is all about. So it's important to note they do have this little asterisk next to earnings here, which points out that when Berkshire buys these businesses, they pay a premium, and certain certain assets. There's pure goodwill, which is not amortized, but they put on the books customer-related assets, other intangibles that are amortized over time, and these totaled $788 million in 2019. Buffett has said elsewhere that he thinks about 20% of those are real, and the reason being that a big chunk are acquired customers, which, all things considered, usually don't decrease in value, but yet from an accounting standpoint, they are reduced, they're expensed. So Berkshire just points out that those are not in this table. They are reported separately. And again, to get us a better picture for the economic returns of the business. We start with the manufacturing businesses. We can see which businesses are in this group. And these are further delineated between these three categories, which we saw earlier. And we can see a modest increase in the overall level of earnings from the businesses. We start with the industrial products. They give us the consolidated revenues here, 31 billion. The pre-tax earnings of 5.6 billion, and then they also give us the pre-tax margin, 18.4% compared to 19. So margins went down for these group of businesses as a whole. We're only told what Precision Castparts revenues are. We're not told what the level of either the margin or what its pre-tax earnings are, which is a little frustrating. We're only given sort of this relative benchmark, but we know that it did 10.3 billion in revenues, slight increase from the prior year. Aerospace markets, but what's important, and they tell us here that there was a ramp up in certain programs. So as the company takes on new business, it does have these. They're usually long-term contracts, and they take a significant amount of setup, essentially, that causes inefficiencies over time. And Boeing is a big customer of Precision Castparts. And of course, as we know, the 737 MAX suspension, that will affect Precision Castparts. So they do expect a volume reduction, but there's other parts of Precision Castparts business, which if you read the full notes at the beginning, the earlier part of the report, tell you that they also operate in industrial turbine products. They have other casted products that serve different markets. So we can see that it actually increased pre-tax earnings 5.1%, but we don't know what the actual number is. You can go back and look at what the business did in 2016, the last year that they had before they acquired Precision Castparts, which was a public company. But as time goes on, that base sort of gets less clear. So there was temporary shutdowns of certain metal facilities, which negatively impacted earnings in 2018. So there was one time of events either in the year that you're looking at or the year before. That is also important to understand. And as we know, the unemployment rate during 2009 was historically low. And so that affected Precision Castparts business, which all things being equal, a shortage of labor would lead to an increase in employment costs. Lubrizol, where we can see its revenue, $6.5 billion. Revenues decreased 5%. So there was, because Lubrizol does business all over the world, that there's that foreign currency effect. But there was also this fire that we learned about earlier. So that affected their level of operations, which restarted a couple months later. But their volume declined 4%. So that decrease in revenues is consistent with the volume decrease. But here we can see that its earnings really fell off a cliff, 50% in the fourth quarter, and for the year decreased 15%. Marmon, again, the huge conglomerate within Berkshire, revenues increased just 2%, and its pre-tax earnings increased 1%. So we do know that it acquired this Colson Medical company in 2019. So that's something to keep in mind, that it did receive a benefit from that. And what we don't have is the specific balance sheet of the company. So we don't know how much additional capital was employed in the business, which is an important piece of information that unfortunately Berkshire does not really supply anymore. So they go through, we can see Marmon's pre-tax earnings decreased for these reasons. Industrial metalworking companies, because it does a lot of business overseas, had some negative effects here. As well as, so the trade war has affected IMC. They do have some business quite a bit of business in China. He mentioned CTB here, nothing huge, and we won't touch on 2018. Building products, kind of interesting here. Remember, building products has all these other huge businesses in it. Shaw Carpet. I mean, Shaw was a public company. I mean, its revenues are probably closing in on $10 billion. And it's aggregated into other. So you have, they specifically talk about Clayton, but these huge businesses, Shaw, MyTech, Acme Brick, Benjamin Moore, I mean, those are all lumped into other, but so we're only given what Clayton did. Clayton's a big part of this segment. It would be nice to know what the other businesses did, but Clayton did increase its business, and essentially what happened was the demand for housing in the United States directly affected positively Clayton's results. So they've increased their site-built home volume over time. So that has helped them even in the face of price declines. And Clayton also benefits from having this huge $16 billion portfolio that they earn. So Berkshire basically has within it a pretty good bank on its balance sheet, which used to be broken out separately into a category called finance and financial products, which began to be consolidated with the manufacturing service and retailing business as beginning in 2018. So we can see pre-tax earnings for Clayton increased 20%, which is just huge year over year. Again, some of that was due to the acquisition of additional businesses, and we don't know how much was spent to acquire those, but nonetheless, that is a good result for Clayton. And the earnings from the financing activities increased 12%, which is pretty good. Other businesses, $13 billion. So they aggregate $13 billion, increased 2.8%, and but nonetheless, we're able to increase earnings by 8.2%. So selling prices, decline in raw material costs. It's pretty broad. It's Berkshire's report, instead of being 144 pages, would be thousands of pages if they gave us all this detail. In some ways, it's not important, but in other ways, it would be nice to know some of the individual happenings of those businesses. Again, we won't touch on 2018. Consumer products revenues declined 5.7%. And a big big contributor is Forest River. And so its demand for its RV products declined 13%, lower unit sales. Berkshire also owns Duracell, so that increased. The apparel and footwear declined 1%. And then Brooks, the separate running shoe company, had this issue with a distribution center in 2019. So modest increase in earnings. But we are, and we can see that they increased, as a whole, increased their margin 1 percentage point in 2018, which is probably an indication that they do have some pricing power, which is good to see. And we know that these are good businesses. Again, we won't touch on 2018. The next segment is the service and retailing businesses. And what's interesting here is it's service and retailing, but then you have the separate McLane. And why is McLane broken out separately? Well, we can see that McLane has huge revenues. I mean, they dominate the segment in terms of revenues, but it's a very basic business of transporting goods from point to point, and so it commands low margins. So even though it has an outsized level of revenues, which is why it's included, because it meets, I believe it's a 10% threshold of a business unit has to be reported separately according to the SEC. So irregardless of what those earnings are. So that's why it's broken out separately. So we can see the pre-tax earnings here decreased slightly in 2019, primarily due to the service category. We take a look at the service businesses. We look here, just a couple paragraphs. So there are a number of businesses here where we really don't have a huge amount of detail, but we do get some detail. TTI increased its revenues 2%, and part of that modest increase in 2018 was a huge increase in sales in 2018. If we pop down here, we can see that that was a 34% increase in 2018. So sometimes when you're making those comparisons, you can jump down and take a look at the prior year. It did acquire a business, so if you take that out, its sales were flat. And Berkshire does note that its sales began to slow in the fourth quarter of 2018 and slowed because of softening demand in 2019. And then the effects of tariffs also affected the business. NetJets and Flight Safety did a little bit better. The media businesses continued to do worse. Charter Brokerage divested a low margin business in 19, which had an effect. We just go through here and look at what the earnings. So the earnings here decreased 8.4%. Why did that happen? So we look, margins decreased from 13.8 to 12.5% overall. And a big part of that was TTI and Flight Safety, offset by NetJets. So we don't know by how much, but we do know some of the reasons why, which are listed here. But it would be nice to know specifically for each business kind of what happened. These one-time things that happened, Berkshire does point out. So here, Flight Safety, there was a significant loss of a government contract in the fourth quarter, which hurt its business. So we are told what happened there. Retailing, we've got all these businesses here, but we are told, and again, for the level of business that's done here, $16 billion, to have 3 short paragraphs. There, as time goes on, if you look at these reports from years past, there were far fewer businesses, but each one basically garnered more real estate in the report because the reports have basically stayed the same length, but as Berkshire has added more businesses, it compresses the level of detail that can be provided and still provide a modest level of reading. So Berkshire Hathaway Automotive, which was the Van Tuyl Group, acquired a few years back. They changed their name. That comprises almost 2/3 of revenues in 2019. So new vehicle sales were flat, but they did have this increase in pre-owned vehicles, home furnishings, again, which make up these four huge, collectively huge furniture retailers across the country, represented 20% of revenues, but they declined 1% this year. Retail group pre-tax earnings increased just very slightly. But so what we can tell is Berkshire Hathaway Automotive had a 23% increase in its earnings because of its finance arm, it looks like. So that means something must have budged elsewhere. And we can see that the home furnishings group, 15% lower, and the rest of the businesses in this group declined 7.9%. So starting to see, you can take away some broad takeaways here, I guess, is, the consumer spending less in furniture, and the jewelers are included in here as well. So you're seeing some strength in some of Berkshire's businesses and some weakness in others. And Berkshire having all of these businesses, Buffett really has almost a real-time view of what's happening in the economy. McLane over the last several years has really suffered in its grocery business primarily because of significant competition, really just driving down margins, which on a net gross basis are about 5%, 6%, net or maybe 1%, and have just really been hammered over the last couple of years. But earnings did increase 17%, but that's on a low base. If you go back to 2016, those earnings were significantly higher, and basically they're saying that it's the grocery business is really the tough one. The beverage or wine distribution business is a pretty good business, but overall, because the grocery, the level of grocery that really dominates the business, and because of those margins going down, really has hurt McLane, and they basically see nothing relenting on that front. So that's the walkthrough of the operating businesses. And now we can go into some of the other earnings segments here. So the investment and derivatives gains, we saw, at the outset, the effect that these have on net earnings. So both realized and unrealized gains totaled $71 billion. There's these derivatives gains and losses, $1.5 billion. You have tax effects. So the net, which was passed right to the income statement, was $57 billion. And Berkshire notes that it was the tax or the accounting change rather that began in 2018 that caused that to happen on the income statement. And they reiterate here that they don't believe they're important from year to year. They say they're meaningless in evaluating economic performance on a year-to-year basis, even though the press often will take headlines and blow them up to make them seem sensational. Derivatives gains and losses, and during the great crash, 2008 and 9, Berkshire originated some of these derivatives and credit swap contracts. These have been on the books for over a decade. They're written on what's called a European style basis, which means they can only be exercised on the date of expiration. So there's nothing in between. So Berkshire only takes the risks that the equity indexes are significantly lower at the conclusion of these contracts. Some of them have already run out. The remainder expire in about 3 years. And there's really not too much to read in here. They do affect earnings because, in theory, as the market fluctuates year to year, they become worth less or more as they sort of track against that final date, that final measurement date. But really, we won't know until they expire. But very, very, very likely that Berkshire makes a good amount of money on these. They've had use of billions of dollars of cash for well over a decade now, and that's a huge benefit, even if they have to pay out some of these. So these liabilities fluctuate up and down from year to year. But the gains in 2019 were $1.5 billion, $300 million loss in 18, and a gain of $718 million in 2017. So those aren't real earnings. It's just really an accounting up and down that happens over time. The other section here, these equity method earnings, these are real. These are important to note. Those come from Kraft Heinz, the Berkshire partnership, as well as Pilot Flying J and the Electric Transmission of Texas. So those earnings are real. But in 2018, Kraft Heinz had this write down of its intangible assets, which flowed through to Berkshire because of its level of ownership, which caused this loss in 2018 from equity method earnings. Those acquisition expenses that we noted in the manufacturing segment, this is where those show up. So Berkshire doesn't report those with those businesses. They say, okay, well, we're going to strip those out. We're going to put them in this other category because we don't think that they're economically real. But they need to reconcile to GAAP, and so that they put them in this other category. Corporate interest expense. So all of the earnings that are reported in the previous sections include any borrowings that those companies have. Only interest on parent level debt shows up here. And because of some of that debt is in foreign currencies, it does flow through the interest expense line actually, but Berkshire's broken that up here. And then there's this income tax adjustment, which we'll explain down here. So we've already talked about the equity method investments. Berkshire borrowed in Japanese yen as well as the pound in 2019. And so those foreign currency, depending on what the dollar does, those effects flow through the income statement. Here, what this $377 million income tax expense adjustment, that relates to a tax equity investment. Basically, last year it came to light that this couple was fraudulently selling these tax credits basically in solar, I believe. So Berkshire, between 2015 and 18, had included in its earnings these tax credits. They found out that they were fraudulent, so they had to reverse them, and that's what most of this income tax adjustment was. We move on to the financial condition. So that was the income. The previous section was all income related. The financial condition talks about Berkshire's balance sheet, the consolidated equity, $425 billion. Again, one of the largest in the world in terms of shareholders' equity. And they note the level of cash, which are primarily treasury bills. And they also note the Kraft Heinz, and as well as the $10 billion Occidental Petroleum preferred investment that was made mid last year. So So again, the debt that's on Berkshire's books, there's parent company debt, which is completely separate from the operations of the specific businesses. But Berkshire does borrow debt and repay debt from time to time. So that increased $3 billion last year. They did borrow in yen and pounds, and they do have some euro-based debt. But you look at this weighted average interest rate on the new debt, less than 0.5%, with maturities going out decades, is just incredible. So Berkshire is taking advantage of the fact that debt markets are accommodative at this point, and they've repeatedly taken a separate look at the assets and liabilities of its balance sheet. So if it makes sense to borrow money, they often will do that, even if they don't have the projects to use them, because usually when there's good times to buy assets, it's not a good time to borrow. So they do often finance those two separately. So the insurance and other borrowings, it's kind of too bad that they don't break them up, because the insurance businesses really don't borrow money. It's really the manufacturing businesses. So other refers to the manufacturing businesses. And a big chunk of this is Berkshire Hathaway Finance Company, which finances Clayton Homes portfolio. So again, it's that mini bank within Berkshire that's financing the Clayton Homes mortgages to its many customers, as well as the leases by the Union Tank Car business. We can see the different repayments and issuances of debt that's occurred over the last year. And Berkshire fully guarantees this $17.7 billion. So Berkshire's on the hook for this $20 billion plus another 18, which in relation to its balance sheet is actually quite modest. To think of a company that has $425 billion of shareholders' equity, and the earnings that it does, that's actually quite a modest amount of debt. Now, the railroad and energy business have debt of their own, but because they're regulated businesses, it makes sense that they do have more debt on their balance sheets. They start out by noting what the capital expenditures will be in 2020 and what they were in 2019, which are quite substantial. So BNSF's debt was $23 billion. They didn't borrow much more during the year. Berkshire Hathaway Energy owes $42.6 billion, which is an increase from the prior year. And importantly, Berkshire does not guarantee any of the debt of the railroad or the utility businesses. But even so, the strength of those businesses afford those companies with significantly lower borrowing costs than many of their peers. This section talks about Berkshire's repurchase of shares. So it has an authorization to repurchase shares, which we talked about. And in 2019, they repurchased $5 billion of both Class A and Class B together, which was about 1% of the company when you view it from a market cap perspective. The contractual obligations, this is another required section by the SEC. And it takes not only the debt and leases that Berkshire has entered in agreements to pay, but also these purchase obligations. It includes the losses, unpaid losses from the insurance businesses. So you total these up, and they look huge, $395 billion. But again, some of them are the insurance lines, and we can see how they're structured here. So specifically, the borrowings, again, relatively modest compared to the resources and income that Berkshire generates. Berkshire takes pains to structure its debt on a long-term basis whenever it can. So we can see of this $164 billion of borrowings, the vast majority is after 2024. So what you want to look for here is, what could cause Berkshire to have a huge cash crunch. This number here, the unpaid losses, stands out. So it expects to pay $26 billion in claims, cash out the door in 2020. But what's not here is the significant level of premiums that it will bring in the next year, which will offset that. So there are enormous cash inflows that offset this table. And when all things are considered, it is fairly conservative. And those discounted life annuity and health benefits, those here are undiscounted. So even with the vast majority after 5 years, those paid that far out are worth, in present value terms, significantly less, but nonetheless, they are not discounted. This section here, these accounting policies. So this is important for readers to understand. And, it's worth going through these every year to see the numbers that might have changed. But largely, if you've taken the time to go through and understand what these mean, you can kind of breeze through. I'll probably go slower than I would if I was reading it on my own. But some of these numbers that jump out. So the insurance businesses have this 115.5 billion of unpaid losses. Most of that are related to GEICO and the reinsurance group. So they kind of break down those. GEICO's gross unpaid losses were 22 billion. Claims liabilities net of reinsurance were 20. So GEICO writes a ton of business, but it also pays out those claims really fast. But still, as of the end of the year, they had unpaid losses of 22 billion. So you compare that to the level of premiums that they have, and they basically, roughly 60% of GEICO's claims or premium volume remain unpaid at any time. Plus, you have the prepaid amounts from claims. So that's what generates that float from GEICO. It's a very fast turnover. Lots of claims written, lots of losses paid, but they continually churn that, and and that's what causes its value. The float as contrasted to the long tail lines, which might have lower payouts but stretch over a longer period of time. So GEICO, it's a pretty statistical business. It will, you kind of have an idea of what your costs will be, but nonetheless, there are these claim estimates that must happen every year. So they have what are known as case reserves, which are the specific reserves that they've put aside. But then there's also these case development liabilities, which average 30% of case reserves. And then what's called incurred but not reported. So if if the year ends 12/31, you're insured, you have GEICO insurance, you've gotten into an accident, New Year's Eve, but you have not reported it to GEICO yet. That's an incurred but not reported loss. So they know that those things are out there, and so they make an estimate for that based on historical data that they have. That's what IBNR refers to. And they also have their estimated liabilities go up and down, as we talked about before, and that totaled 42 million in 2019. Here they're talking about the bodily injury claims. So a change of 1 percentage point in those liabilities can impact earnings by about 300 million, and they quantify that. We look at the Berkshire Hathaway Reinsurance Group. What's interesting about this table, they have all of these huge amounts of unpaid losses. Very, very little is reinsurance recoverable. And Berkshire intentionally, part of its business model is actually taking on the risk of others, but it does not want to buy reinsurance if it can't help because when things really go bad, if that insurer is not around, uh, Berkshire would be on the hook anyway. So they say we're going to take the risk, and it's a risk that some other insurers, primary insurers, and even reinsurers take, is they don't account for the fact that when they need insurance, it must be there. But it's a big part of Berkshire's strength because Berkshire, everybody knows that Berkshire can and will pay, even if those payment dates are far into the future. So with GEICO, again, pretty straightforward, but with the reinsurance business, there's a few factors that work against the company having a more precise level of understanding of what its ultimate liabilities will be. So just first, that the nature of the business, which is one level removed from the primary insurer. So their data is it's late because it takes time to compile that, as well as it could be subject to the estimation errors of those primary insurers. And more often than not, it's more optimistic than they should be. So some of it, and some of it is because it takes so long for these to develop. It's very hard to tell what the liability for something might be 10 or 20 years into the future. And even some companies, as this statement is saying here, they infrequently provide their own incurred but not reported estimates up to the reinsurers. And even some of them can take up to 6 months to pass along their estimation. So Berkshire will do its own level of estimates. And right here, we're seeing that Berkshire's done its own estimates for case losses and determined that it's probably $2 billion higher in terms of workers' comp from claims occurring 10 years ago than the primary companies have actually said. So Berkshire does its own math. It has its own auditing function that actually goes out and we'll test some of these. There's certain litigation that's just normal part of the business when there's disputes. But Berkshire is generally on the conservative side, and these factors here go into the methodologies by which they will determine what the liabilities are. Again, these catastrophe, individual risks, excessive loss, low frequency, high severity. So that's what causes the lumpiness in the business, where a couple of years could go by where there's huge profits because there's not many losses, and then when they do hit, they're usually very big. And those, because they're so infrequent, don't have the historical data available generally to provide a statistical analysis like something such as the auto insurers. This section's talking about some of the loss adjustment expenses or loss adjustments that have occurred through the business. And here we can see the retroactive reinsurance business, $42 billion of gross unpaid losses. Of course, that's offset by those deferred charges for a net unpaid of $29 billion. And then very importantly, in this type of insurance are maximum limits. So Berkshire always makes sure to cap the amount that they are willing to lose on any contract, because they just don't know. So they have a worst case in mind, and then they put, just like investments, they'll put margins of safety in their insurance contracts because they know that it's an imprecise business. And they think it's unlikely that they'll move up or down by 15%. And so part of part of the retroactive reinsurance business have these asbestos, liability, latent injury claims, that type of business. They estimate that they're about $13 billion. And again, these are capped. So really the big thing is timing, and a significant amount of that business, that timing can happen because of legal action. They tend to be they can tend to be quicker, but that's all part of that business. And here we can see the increased the liabilities, that unfavorable development uh, with retroactive insurance by $378 million. But because of that deferred charge asset, so they ultimately think that they will lose $378 million more on those contracts, but the net hit to underwriting profitability was $125 million. So because part of that gets booked as an additional deferred charge asset and then amortized over time. And here's an important piece, this sentence here, talking about the actual payments from these contracts. So up here we're told that the net liability, actually the gross unpaid losses of 42 billion sitting there on the books, but only less than $1 billion actually went out the door. So that gives you a sense of the actual cash flows coming from the business. And those deferred charges, Berkshire estimates will be 1.2 billion, which is just a huge amount. So even if no additional contracts are written in 2020, that charge will amount to the same amount, absent. That will be in addition to any other loss development. But that 1.2 billion will hit earnings regardless of the level of new contracts that happen or any loss development. Of course, Berkshire's balance sheet, and we'll take a look at that in the next segment. But Berkshire's balance sheet has a huge amount of goodwill because it's paid a premium over the level of tangible assets of its many businesses. So goodwill was 82 billion plus 19 billion of other intangible assets. So Berkshire has about 100 billion of goodwill and intangibles on its balance sheet. This section, again, it's mandated by the SEC. Berkshire reiterates that it has 67% in 5 of its top equity holdings. They hold them for long periods of time. They basically don't care about the level of volatility, and they note that they have significant capital and liquidity to manage through any hypothetical swings. And so it's pretty straightforward math. Sometimes this math does does differ depending on what the assets or liabilities are, but it just quantifies. So this 248 billion, what a swing plus or minus would do to those equities as well as the liabilities that it has on the balance sheet. Interest rate risk, again, just quantifying what changes in interest rates would do to the fair value of various assets and liabilities. Of course, we know as rates increase, that decreases the fair value of a liability. So a 300 basis point increase would actually decrease the fair value of the railroad debt. And it would also decrease the fair value of some of its investments as well. Berkshire has foreign currency risk in several ways. So even some of its major investees, it points out the Coca-Cola company does, I believe, over 80% of its business overseas, which Berkshire doesn't try to hedge out in any way. They don't attempt to play games with hedging. And Buffett has said, when he did his interview with the Financial Crisis Inquiry Commission, he talked about hedging, and he said, basically, I know that things are going to go up and down over time. They're going to net out over time. we don't really care what Berkshire's earnings are reported because of that. But if we hedged, we would be out the premium that it costs us to put on those hedges. So they don't hedge in any way as a rule, but the railroad and energy businesses do hedge because they have contracts with certain certain customers, especially the utility businesses. Even though in the long term it might net out, regulators prefer and customers prefer that their bills are fairly steady over time. So they do engage in hedging in that way. Of course, Berkshire has income, assets, and liabilities and expenses in foreign currencies. So that is the sort of formal 10K section of the report, and the next main segment is the actual audit, and we'll get into that in this next segment. I think this segment is pushing 2 hours here, so we'll stop here and pick up the actual Berkshire Hathaway audit report in the next segment.